Good afternoon, good morning, good evening, wherever you are. Welcome to this webinar by the Nuclear Energy Agency and the IFNEC financing initiatives on contractual structures and incentives in nuclear new build. Other than contractual structures, we'll also be looking at liability arrangements and risk management, and as well as incentives. And we have a very distinguished panel composed both of industry experts and of academics who will help us to shine a light on this important topic and to analyze its impact on the costs and performance of nuclear new build. Our webinar will try to identify what worked well in the past and what didn't work not so well also, and primarily will aim at developing some perspectives for the future, both for the analyst and the practitioner. With that, I would like to hand over to Diane Cameron, who is the head of the NTE division on nuclear technology development and economics of the Nuclear Energy Agency. She's a former director of nuclear affairs in the Canadian Civil Service and is overseeing this work at the NEA. Diane, over to you.
Many thanks and welcome everyone. It is my pleasure to be here today to welcome you, to welcome our panelists and welcome the audience for what I believe will be an excellent conversation on a very important topic. Within the Nuclear Energy Agency, as our chief economist Jan Kepler mentioned, I have the great privilege of serving as head of the Division for Nuclear Technology Development and Economics. That includes overseeing a very ambitious program of work that includes a lot of forward analysis and research and engagement in the area of nuclear economics, cost reductions, financing challenges, as well as a program of work in the technology area. And we like to undertake this work in collaboration with strategic partners. And chief amongst our strategic partners are some of our fellow international organizations like the International Framework for Nuclear Energy Cooperation. Today's event is part of a series of webinars organized by the International Framework for Nuclear Energy Cooperation in collaboration with the NEA, the Nuclear Energy Agency. The series kicked off in January with an introductory session on financing of nuclear new build, followed by a session on financing of SMRs, in particular focusing on challenges and opportunities. And more recently in July, a session on taxonomies, ESG financing, so that's environmental, social, and governance criteria for financing, the role of nuclear in these green and clean energy climate financing portfolios. Today's session, we are focusing on contractual structures, efficient risk allocation and incentives in nuclear new builds. And we are building momentum through this series of webinars for a high-level policy workshop on nuclear financing that will be hosted in Warsaw, Poland. We hope later this fall, if not in person, then virtually. Both the webinar on contractual structures and the financing initiative are part of a long-standing program of work at the NEA, as I mentioned, on assessing the costs of nuclear new build and on identifying options to reduce those costs in the context of ongoing decarbonization and the electrification of sectors across economies of the NEA member countries. Our current program of work for 2021 and 2022 at the NEA includes a project on contractual structures, which we expect will benefit greatly from the insights and inputs put forward in today's discussion. Look forward to a long-term conversation extending well beyond this webinar with the distinguished panelists, as well as the participants in the audience. This is an important conversation for us. We look forward to learning from you and to engaging with you. I look forward to the conversation today. Wish you the best of luck. Back to you, Jan.
Thank you very much, Diane. Thank you for putting this all in perspective and also the perspective of our work and how important this webinar is for this work. This brings us to the to the panel, to our 7 speakers. Let me very briefly, before handing it over to Simon Taylor from Cambridge University, very briefly give you an outline how the panel is organized. We'll first have an academic view. We'll then have a view from somebody who can make sort of the bridge between the academics and the practical experiences. Then we'll have 3 different industry views, and we'll finish again with an academic view, and finally with a view from the international organizations, from the NEA. So you have a little bit of an arc, twice the academic or IO view, and in the middle then the practical experience. With that, the first speaker will be Simon Taylor, who is Professor of Finance at the University of Cambridge. Simon has a long experience, both of course in teaching and research, but also in the city, at major financial institutions, and is of course has become well known in the last few years for his work on nuclear financing. So with no further ado, Simon, over to you, please.
Thank you, and hello everybody. I'm going to talk about what in the UK we call the RAB model, which I'll explain in a moment, which essentially is a model which it is now quite likely is going to be used for the financing of the next new nuclear power station in the UK, Sizewell C. I'm also going to add my view that I think it's a model that's worth considering. It has merit. So the starting point is that, as everyone probably knows, one of the most basic principles in finance is that we expect that risks will be related to expected returns. And this works out very much in practice up to a point. We see low risk investments like government bonds, which have a low return. We see higher risk investments like public equities, which have a higher return. But there are some projects or investments where either because the risk is too high or because it cannot be calculated or estimated with any confidence, there is no private finance forthcoming, not for any prospective return that could be there. One example is investing in the higher risk developing economies, and another is, of course, investing in brand new nuclear power stations. There is no appetite from private finance for new nuclear power stations without some further incentive. Now, if we have a situation like this, 3 things could happen. First is nothing, no investment takes place. A second is that the government can try and fill the gap, which may be better than nothing, but of course governments are financially constrained and in many cases maybe not the best people to actually run such a project. The third is that the government or some other credible entity provides some degree of insurance that takes away the more extreme bad outcomes, and that can then allow private finance to come in. And in the case of developing countries, we have entities like export credit banks, we have the World Bank, and they provide partial guarantees that in effect limit the risk to private investors. And on that basis, some investment then takes place. And that's the essence of what is probably going to happen in the UK. Just to provide context, as you probably know, the British government has remained very much on track to wish to build or get built at least 1 more nuclear power station in the UK. That's been a pretty consistent policy over several years. The policy in the past was constrained by the government's refusal, in effect, to take risk directly on behalf of the government or the taxpayer. That policy is now changed, or appears to have changed. The power station under construction at present, Hinkley Point C, was financed on the basis that essentially, if the government would not take the construction risk, the investors must take it. They were willing to take it on the basis that they would have a higher expected return. The original return was put somewhere in the region of a 10% project return, although if you allow for leverage and debt, that could be considerably higher. Now, the inevitable consequence of that is that for a very capital intensive project, a higher cost of capital puts up the electricity price, which is then consistent with making the whole project work. And as is well known, the strike price agreed in the contract for the Hinkley Point C electricity is £92.50 in 2012 prices. It's indexed to inflation. It's already well over £100. and will keep rising for the duration of the project. And the result is that we have a price which is far higher than current wholesale prices in the UK market for electricity, which are in the region of, let's say, around £60. So partly because the investors, including EDF, did not want to replicate that model in future, and partly because the government was under pressure to come up with a much lower electricity price for future nuclear, there's been a rethink. And the good news is that what's come out of that is a model which draws on existing UK utility regulation and on a precedent, which is called the Thames Tideway Tunnel, a major construction project currently taking place in London. So the first part of this is that the UK adopted utility regulation when it privatized its utilities, starting in the late 1980s with first telecoms and then gas and then electricity and water. It looked to the US for, as it were, a model. The US had a very successful, in certain respects, regulatory model, which basically gave a guaranteed rate of return for agreed increments of investment. Now, if your main goal is to motivate investment, that model works very well. In the case of the UK at that point, the goal was not so much new investment, but trying to make more efficiency savings with the existing assets. So the UK introduced an incentive element, and effectively the typical utility model regulation in the UK is that the regulator sets revenues for a fixed period of time, typically 5 years, on the basis of an assumed rate of return. However, if the utility is able to cut its costs and economize within that fixed revenue framework, it gets to keep any additional profit until the next setting of the prices, which will then, of course, take into account the efficiency savings. So the benefit is the utilities are incentivized, and over time, prices come down, the customer is happy, everybody benefits. Now, that system has the merit that it's been in operation since the late 1980s. It is pretty much trusted and credible with investors. However, what's become clear, perhaps it wasn't obvious at the beginning, is that over time, as the incentives become more and more limited because costs are harder and harder to take out, that system in effect converges on a rate of return formula, more or less. And therefore, most of the arguments that go on in utility regulation in the UK are about the cost of capital. We've had a big dispute recently, but it seems to have been resolved. Now, that framework can be used beyond utilities, and it has now been adapted in the case of a single project, the Thames Tideway Tunnel project. This is essentially a large new sewage pipe under London to increase the capacity of the overstretched London sewage system, most of which was built in the last century but one. And this project was too big for the individual utility, Thames Water, to take on. So it was created as essentially a standalone new company, and it draws on that utility regulation approach. The reason it's called the RAB model, or the regulatory asset base, is effectively for each pound or dollar or euro of capital invested, the regulator will give you a revenue corresponding to a certain rate of return. And that's very attractive to investors because there is a huge market, particularly in the UK, because we have a lot of mature pension funds that want low risk but very predictable low return investments, particularly long-term ones. However, that still leaves a question of who bears the construction risk. And although this is not a particularly complex project, nonetheless, there are risks. And the key innovation there is that the government, in effect, has undertaken to provide the financing if the project goes over a defined threshold amount. At that point, the investors can, if they wish, put more capital in, but they're not obliged to. In effect, the government is insuring against the really, as it were, extreme cost overruns, which hopefully won't happen, but the risk is not zero. Now, that model has worked very successfully in the sense the project is under construction. It attracted plenty of funding, and the basic rate of return priced into that system is 2.5% in real terms, which even in today's low interest rate world, that's a pretty low rate of return because the risks are acceptable. So at some point, somebody thought, well, can this be adapted to nuclear? Conceptually, there's no fundamental difference between building a large tunnel under London and building a new nuclear power station. The question is partly one of scale. So the Thames Tideway Tunnel is about £4 billion in total, say 5 billion euros. The Sizewell C project is more like £20 billion. But the other issue is, of course, how confident can the government be that it won't actually end up picking up a large part of the cost? Now, this is fundamentally all to be negotiated, and indeed negotiations are already in process, and we expect the government to make an announcement probably later this autumn. But the basic building block of this is that if the government is able to reach a point where it is willing to, in effect, insure or underwrite the costs above a certain threshold level, it will leave private investors with essentially a range of returns, which will go from low to moderately high, but probably not very high. Now, you want there to be some incentive left in the system, and that is what the Thames Tideway Tunnel project has. The rate of return that I quoted is a kind of an expectation, but there is some sharing of cost overruns between the investors and the customers. The point is to constrain the range of outcomes, but to still leave some incentive for the investors to manage the project and put pressure on the contractors, because otherwise the risk is nobody really cares what happens to costs. That is the framework which has now been accepted by the government in the UK, and the evidence, it's not overwhelming, but it's reasonably encouraging, is that there are a lot of UK financial institutions which are willing in principle to invest both in equity and in debt in a project for Sizewell C on that basis. There's a certain amount of detail that clearly has to be agreed, and one of the critical things is what is the threshold for the cost overruns. I should emphasize that this is not a free lunch. The government is, on behalf of taxpayers, taking risk. It's effectively providing insurance, or an option if you prefer. And in that sense, that could crystallize. The government could, in some, if the costs overrun badly, could end up having to put money into the project. From a political point of view, costing such insurance or such promises is kind of difficult and opaque. And actually that helps politicians, because frankly, the general public aren't likely to be able to really understand what that amounts to. But from an economics point of view, we shouldn't pretend that this is free. Nonetheless, the overall benefit is that with reasonable assumptions about the construction cost coming down and the kind of rates of return that might be feasible, it would be possible to get a strike price for Sizewell C for the electricity in the region of £60 a megawatt hour. Now, that's still above what we've seen for recent offshore wind auctions, but of course this will be baseload power, and it also could be regarded as having value as being a diversification within the UK electricity generation. And of course, that's the second basic principle of finance. The diversification is a good thing. So in my view, and the view of my colleagues, this is the least bad way, shall we say, of going about financing a new nuclear power station in the UK. It should be feasible. It is reasonably transparent. I would say that there's some hostile press commentary on this idea, but it's oddly enough, it's focusing on the issue that the companies, the investors, would receive a return on their investment from as soon as they put it in, as opposed to waiting for the project to be completed. And that is, I think that's politically the hardest part of this. One person said, well, it's a bit like paying for the restaurant before you've even ordered your meal. But that may be something the government needs to somehow get people comfortable with. But of course, that is part of keeping down the cost of capital and making it appealing to particularly those institutional investors that don't want to take too much risk. So in summary, this looks like a big improvement, in my view, over how Hinkley Point C was financed, and I think it is worth consideration elsewhere. Thank you.
Thank you very much, Simon, for getting this webinar going with a very succinct and useful sort of backdrop of the RAB model, which is increasingly becoming a reference. And you also worked out very well for us and for the participants in the audience. And it's a bit of a tightrope walk between ensuring enough so that private investors are interested, but not ensuring too much so that incentives are not completely stunted. And if you pay for your restaurant meal before you actually ordered or saw it, you definitely want the cook to have the right incentive to prepare a good meal. With that, I will hand over to Milt Kaplan, who is the president of MZ Consulting, is now a consultant. has more than 40 years in the nuclear industry, both advising governments, working for governments, a system operator. He has very clearly a superb network throughout the Canadian nuclear industry. And also beyond that, because he is the chair of the Economics Working Group of the World Nuclear Association, the WNA, and also teaches in their World Nuclear University. Milt is a very good transition between the more academic point of view and the more applied industry point of view. So Milt, please, over to you.
Well, thank you, Jan, and good morning, everyone, from here in beautiful downtown Toronto, Canada, where it is morning. And what I want to do is I want to start off by stepping back a little bit and talking about some of the bigger issues and why it's important we address them. And, you know, how did we get here, right? If we look at the last 30 years or so, we had some driving forces to sort of shape how we want to manage risk in projects. One is starting in the early 1990s, we had the push towards large-scale market deregulation. And the other is, as we've had for years and decades in large projects, we've had a lot of projects that tend to have not performed as well as they could have. And unfortunately, I guess now in hindsight, the risk model that we all moved to when we thought risks were too high was to say, let's push the risk on someone else. Let's try and make it so that someone else takes all the risk, and predominantly, let's try and push that risk down as far as we can. And we know now that, you know, that doesn't work so well. We've seen it in some of the bigger projects in Finland. You're going to hear some about what's happened in the US. And even though a lot of the risk was pushed onto the vendors, that doesn't mean the projects actually came out with good outcomes. And so where we had the, whoops, I didn't put this on. Where we actually had the aha moment, which is what drove the RAB model that Simon just talked about, is back in 2017, after the National Audit Office did a review of the Hinkley Point contract for difference model. Buried in, you know, one of the little appendices was this fantastic chart. And this chart was a big wake up for many people. Now, for most of us that do this kind of work, we've seen this chart before. The NEA puts out a beautiful report together with the IEA called Projected Cost of Electricity every 5 years or so. And there's always a chart that shows the cost of capital compared to the cost of energy. And we can see that the slope is always very steep. But this makes it real, because exactly as Simon said, you know, you can look at the Hinkley C model and say, wow, we're paying £92.50 per megawatt hour for energy. And if we can find a model that brings the cost of capital down to 6%, that could be a $60 or £60 per megawatt hour cost of energy. You know, how wonderful would that be? Now, in theory, it's easy to say that, but this is what gets people to think. And what it gets you to think is looking, we have to remember some big issues. You know, when it comes to reducing the cost of capital, it requires a discussion about risk. And Simon just went over that in some detail and explained why, you know, different models have different risk profiles. But I think the real lesson here, and we learned it as well, I do independent oversight for the Darlington refurbishment project here in Canada. And the next speaker, Zena, you know, who's one of the masterminds behind that project, will explain in detail why that project's being very successful. But some of the sort of things that we have to understand now is this model of allocating risk has issues with it, because one thing you have to realize, if you're the project owner, the risk resides with you. It's your project, it's your money. You know, there may be ideas where people think, wow, you put a lot of risk on the contractor in Finland or in the US, but, you know, if the finished project is, you know, a dozen years late, you know, kind of how's that working for you? So in reality, it's important that we understand that transferring all risk to contractors is an illusion. Allocating risk is a form of risk management. It's how you help manage risk to incentivize behaviors. the risk does not go away just because you want to close your eyes and say, you know, I'm taking on this project because someone else is worried about it. Because remember, this is, I think, an important way to think about it. There is no scenario where your contractor fails and you succeed. And once you realize that, then you realize you have to do something different. And it's also important to maintain a structure with transparency, because one of the things that pushing risk down too far is then the contractor says to you, I'm taking the risk. I don't need to tell you what's going on. Don't worry. The problem with that is what the contractor will tend to do is say, everything's fine, everything's fine, everything's fine, and then go, you know, oh crap, we're in big trouble. And with transparency, you can take action early to try and correct issues rather than worry about whose fault they are. And so if you look at some of the things you need to do, you have to remember one thing: contract structure cannot replace good project management. If for a project to succeed, you have to have high quality project management. And what that means is a few things that we can talk about now. One, be prepared. Plan, and plan some more. And one of the problems with putting too much risk down the pipe is that nobody wants to spend enough money to get ready before they're forced to take on that fixed price. And then they get stuck with a cost and schedule they can't deliver to. You know, I'm sure John from MIT is going to tell us, ensure adequate design completion before construction. I mean, we've been saying that for years, but not everybody does it. But on the other side of having your design complete, the other part of a big project is you have to have your supply chain ready. In a lot of projects, what we've seen is that the supply chain has been idle for a long period of time, and then they struggle to get ready when the orders come in. Now, most important in a big project, you have to create strong project metrics. And remember, metrics is different than a project statistic. Nothing is more frustrating than when people report % complete on a project. Knowing your project is X% complete doesn't tell you anything. A metric is something that compares that % complete to an expectation. And the reality is numbers don't lie. People may, but numbers don't lie. And once you have proper project metrics, you also have to develop and implement a robust project risk management program and use that risk management program as your basis for developing contingencies. And then once you get all these things under control, you can develop the project financial structure, and you need one that supports preparation before final commitment. What you'll hear from the next speaker is they had a project definition phase where they spent a significant amount of money, and only then, after they had an estimate that was deemed to be class 2 and a project schedule that they believed was credible, did they then get approval to move that project forward. And that's why that project, you know, is still on time and on budget. And the final thing to remember, projects are about people. So you need to get the best people you can, because everything that happens is keeping people, incentivizing people, and having them focus on success. So just to bring this introduction to a close, I'm not saying exactly what type of structure you should have here, but in the end, what this graph tells you is if I take a model that ends up giving me this kind of rate of return, and customers have to pay this price for energy, or I can find a model down here, the real question is very simple. Is this difference worth it? Is the price I'm paying for someone else to take that risk worth what I'm getting in return? And in reality, the chances on these really big projects are no, because once the projects get underway, even though people say they're taking risks, once the project gets in trouble, they come crying to you and saying, I want more money or I'm going to abandon. And that's not what you want. So just as key takeaways, before you hear about the details of the OPG project, remember, big projects are hard. Risk allocation does not ensure project outcomes. it's very important that parties focus on success. A lot of the discussion about project risk sharing, especially when you're trying to push risk on people, is about trying to figure out who suffers when things fail. And so remember, there is no scenario where your contractor fails and you succeed. So focus on success, not on what happens during failure. And then you can develop contract structures that can incentivize the kind of project management and behaviors that you want. And so I think that's a good place for me to stop, and I'm looking forward to a good discussion going forward. Thank you so much.
Thank you, Milt. That was very, very good. And I will certainly sort of keep among the sort of striking sentences that sort of organize my thinking in this area. Contract structure cannot substitute for good project management. That is really an important sentence. And you also gave some good pointers in terms of transparency, metrics, planning, of course, design completion, and the quality of the people. So once we take this work further, that will certainly stay with us. At the level of the panel, we'll stay in Canada, actually. We'll move to Zaina Elhami, who is the Vice President for Commercial and Project Assurance at Ontario Power Generation. And she is one of the people responsible for one of the biggest nuclear projects anywhere in the world, the refurbishment of the Darlington Power Station. And she has a long years of experience, not only in the nuclear industry, but also in the aerospace industry. So we've long been talking also about benchmarking and benchmarking new build compared to other industry and so forth. So I don't know whether she will be talking to us about this today, but definitely we want to hear about her experience with the Darlington project. Zaina, over to you, please.
Thank you for having me. And I'm actually going to focus the discussion more around the Darlington refurbishment project and some of our successes there. A lot of what Milt talked about resonated very well with me, because he really did highlight some of the things that really drove our success on our project. And I wanted to kind of leave you with some of key things that we have done that helped us along the way. But maybe first, I thought I'd give you a little bit of insight about the Darlington Station, just to kind of frame it a bit and let you know a little bit about that mega project. So the Darlington Station, if you're not familiar with it, is about an hour east of Toronto. It was put in service in 1990, and as part of its design, it was required to do a midlife refurbishment to allow the extension of service for another 30 years. And so we've embarked on this project about 10 years ago to do this refurbishment. It's a 4-unit. It took us 10 years to plan for that project. Milt highlighted the importance of planning. We really did not take that lightly. And when I talk about planning here, it's not just about the estimates, but also about the infrastructure and the staffing and the contract selection, the approval of our budget. And then we've got 10 years of actual execution work to complete all 4 units. The dollar magnitude of that project, it's a $12.8 billion investment. That's a Canadian dollar, but that's still very significant dollar value. Our structure from a contractual perspective, it's a multi-prime project with OPG, Ontario Power Generation, working as an integrator. And just from a status perspective, the planning is all behind us. Our first unit is already have been completed and put into service. And I'm really pleased to say that it was on budget, and we are already about 40% complete on our second unit, and we're tracking on budget and on schedule. In fact, we're a little bit ahead of schedule. So really, when you look at the magnitude of that project and you look at the great performance we've been having up to date, it's quite substantial, quite significant, and we're really pleased with where we're at. But I could tell you, it didn't quite start that way. We did do a lot of planning, and we right off the bat, things were progressing well, but we did come to points where we thought we saw ourselves behind schedule. We saw ourselves with technical difficulties that we had to overcome. We saw ourselves with vendors that were struggling, and we really took the approach of we needed to step in and do something about it. So when I was trying to think about really what drove our success in that project, yes, the planning, absolutely, great project managers, absolutely, risks properly allocated, yes, but also the agility that the team brought to this area. When we saw our vendor not performing well, we did not want to step back and just watch them fail. We knew that if they fail, we fail. So what can we do to make sure that this project is successful, that our vendors are successful? And we pivoted our way of thinking. And we really went forward with a much more collaborative approach with our vendor, looking at issues in the field, supporting them, really putting in place a very strong lessons learned program. We've documented over 4,000 lessons learned. And when I look at that number, I mean, it's a huge number, and not all of them were, some of them were process improvement, small things, but some were significant that we really took the time and put in place the processes that allowed us to really put them in the field and capitalize on those. And Milt talked about transparency. I mean, that was key for us. We really take the time with our vendor to look at our budget, to look at our estimates. We do what we call a bottom up of our estimates, and we create challenge meetings and opportunities for us to collaborate and have an open dialogue around our risks, around our financial, around things that are happening in the field, and really support the vendor in our insight to make sure that the outcome is where we need it to be. I wanted to add the long lead material item, and that was another thing actually Milt highlighted. And although you would look at that and you say, well, this is not quite an agile mindset, really, but it was extremely important for us, especially as the pandemic hit. When a lot of organizations were struggling with supply chain, this was not an issue for us. We were already about 95% complete as far as supply chain is concerned on our next unit, and about 40% complete on the unit ahead of that, and already in our warehouse. So it really created an opportunity for us to focus on other elements that the pandemic had thrown on us and required us to pivot, because supply chain was really not an issue for us. And the last one I would say is really the relationship that we have with our trade unions. We've always had a very strong relationship. We cherish that relationship, but we were really, put a lot of focus on flourishing it even further, because we knew as our project is moving along, as challenges are coming along, we needed to pivot, and having our union representative on our side and on our champion through that was really an important point for us. So to kind of leave you with a pretty, a little bit more direct things that we've done, I've already talked about, moving from an oversight to an integrated project model. We co-located our staff and seconded our key resources. We actually, what I mean by that, we really took the time to look at org chart, organizational chart, and really looked at who are the best people to be in what position. And if that was an employee within OPG, then OPG seconded that employee over to the vendor so they can do the job for them. And really what that created, the mindset we had there, we talked about best athlete approach. who is the best person to do the job? Because again, if they succeed, we succeed. And the other thing we really spent a lot of time on is creating a culture that is positive, that is transparent, that encourage the opportunity to challenge, people can speak their mind. And really what we branded that culture, we called it a one team culture. This is a one team environment between the owner and the contractor. And we really took the time to set the behavior that we want to see from both parties. We worked with our vendors on that. And we really do, we use one team became an adjective for us right now. If somebody behaves in a certain way that it doesn't quite fit what we expect, people would say, this is a not one team behavior. We expect you to adjust. And the other thing that we really wanted to make sure it is that collaboration is so strong that when people come into our facility, it is really hard for them to distinguish who is the contractor and who is the vendor. And when people tell us that when they visit us, it feels good. We know we've achieved the vision that we wanted to achieve. The other thing we did when our vendors were struggling from a disincentive perspective and so forth, we sat back and we rebalanced their incentive and disincentive. And that was a really a pivoting point for us because we didn't necessarily want to get our vendor off the hook on poor performance, but we knew that this is a long-term relationship that we were going to have with that vendor. And having a vendor at the very early stage of the contract already, not seeing the opportunity from an incentive, losing that hope that they're going to be doing quite well at the end of the road, it wasn't an environment that we really wanted. And we worked with them based on a revised estimate that we're both confident with to rebalance the incentive and disincentives. And the one last thing that I would leave you with is that when we did that all along the way, we never lost sight of the risk allocation. So we always went back and looked who owned that risk, who paid for that risk, who is best to carry that risk. And we made sure that all along and all these great things that we've done to keep our project on time and on schedule is that we've documented from a contractual perspective, and we made sure that the risk is clearly highlighted. So, really pleased where we're at with the project. We're not done yet, so we can't really quite celebrate, but we're heading in absolutely the right direction. We've got a team that's quite focused on these principal, a vendor that is quite engaged. And we're really pleased with how that's going. And the learning that we had on the refurbishment project, the Darlington refurbishment project specifically, we know the formula works and it worked for us. And we intend to continue to apply that as we move forward and look at the new nuclear and the contracting strategies that we would be putting in place. And really, we see a great momentum within our organization about this model. And we're getting a lot of projects who are outside of the nuclear coming back into us and benchmarking and saying, what can we learn from what you have done so we can carry that forward. So with that, I hope you can take away a couple of things that we've done and made you think about your project and how you can apply that in your space. And I'll turn it over back to you. Thank you.
Thank you very much, Dana. A lot of things are going right apparently at Darlington, which is great, which is really positive, and your presentation will encourage us to look even more closely at how you're doing it, whether the one team culture is a specific Canadian phenomenon or whether it can be replicated also elsewhere. Certainly things like transparency and a good forward planning and taking a proactive approach. Some of these things are very clearly transferable. Others perhaps more difficult, but who knows? And we'll certainly look at it with great interest. Thank you very much. We will now move on to another very distinguished speaker and very high-profile project. The next speaker will be Sean Shaler, who is Managing Director at Southern Company and responsible for nuclear development. And he has worked in a senior leadership capacity for the past 13 years at the Vogel plant. Which is clearly one of the most high-profile new build projects in the OECD countries, and we definitely look forward to hear about what went well at Vogel, what went perhaps, or what posed challenges at Vogel at some point, and how they were overcome. And Sean also has experience from the other side, if I may say so, of the contract in construction. So he's very, very well placed to understand us better, the Vogel project. With that, Sean, over to you, please.
So thank you, Jan. First off, I'd like to say that I'm very happy to be able to attend this webinar today and found the comments and input from my fellow panel colleagues to be very interesting and informative. I can promise everyone, as far as the attendees to the webinar, we haven't shared these presentations with one another, but it's very interesting to me that there are a lot of common themes that I'm going to not only reinforce from the previous attendees, but add to as well. And so I do not have any slides today, so I'm going to be speaking extemporaneously from the heart on this subject. And there's kind of really three areas that I will be speaking on today. The first is I tend to want to give some context so as to frame the perspective of my comments. Then I'd like to discuss the importance of upfront planning and due diligence by the parties prior to the selection of a contract model. And this was echoed in some of these earlier presentations as well. I would be remiss, I think, if we were talking about contract structures and incentives, that we didn't spend at least a few minutes discussing the foundational aspects of large-scale capital project management. This early stage front-end planning and decision-making truly sets the stage for project success, because a contract delivery model simply wraps around that planning. And then lastly, I'd like to talk about our current approach at Plant Vogel and what has worked for us regarding contract model and incentives. So, as I mentioned, I'm the managing director with Southern Company Nuclear Services, which is part of Southern Company. We're a utility based in southeastern United States. Southern and its Alabama Power, Southern Nuclear Operating Company, its co-owners are currently the owner-operator licensee of over 6,000 megawatts of nuclear generating capacity. In addition to our existing nuclear operating fleet, as mentioned, we are in the process of completing Plant Vogel Units 3 and 4 in Georgia. This will be the first greenfield new nuclear units brought online in the United States in over 35 years. By 2023, we'll have 2 Westinghouse AP1000 reactors operational at Vogel, making it the single largest generating facility in the United States and bringing our total nuclear generating capacity to over 8,000 megawatts. Very simply, in the owner-contractual commercial relationship, we're the owners. And so by nature of the work that we performed at Vogel 3 and 4, we've been through several successes and challenges. And we've developed our experience, our institutional knowledge, and as I like to say, a particular set of skills in nuclear project development, as well as acquiring a significant number of lessons learned along the way. So recently, we began to share those lessons learned and experience with other like-minded utilities and governmental entities worldwide, helping advise the leadership and the project teams on what can be at times a challenging journey. As mentioned previously, no one here today is likely to say that new nuclear project development is easy. Many here know that it's absolutely necessary and worthwhile to achieve the clean energy goals that we all aspire to. We have walked quite a bit in the shoes of a project developer, and now we're helping others with that journey as well. So the second part is what we've talked that I'd like to speak on today is upfront planning and due diligence, and it's been mentioned previously. It's difficult to get in a detailed discussion in this short period, but I do think it can be addressed at a high level. In conversations such as this one and with others, I often get asked some form of the same question. What is the best contract model for quote unquote my project? It's often phrased as a multiple choice question, EPC, EPCM, contract for difference, cost plus, incentives, and it's proposed in a way that makes it a separate decision, at least from an owner's perspective, that must be made alongside a host of other project decisions like choosing a technology or licensing path. The opposite, in fact, is true. The selection of a project delivery model is the culmination of multiple decisions, fact gathering, and upfront planning. It's very much an integrated decision. And another assumption is what that is often made is what did and did not work well for us at Vogel will obviously have the same effect for the project in question. That's not necessarily true. And so I give the same answer that I often hear from my esteemed colleagues in the legal profession that I work alongside. For the record, I'm not a lawyer myself, but I work with them quite a bit. And the answer I give is, it depends. Inevitably, there's a letdown when I give that answer. Folks were expecting a simple secret formula to contracting and project success that can be applied universally. And it's possible to a certain extent, but each project has its own unique set of challenges. And so in my experience, the project delivery model and the associated commercial strategy incentives really is the wraparound of your overall project execution strategy. The delivery model is an extension of that strategy rather than the foundation for it. Your core project strategy, meaning the allocation of project risk, the division of responsibilities, your defined work scope, the ability to identify and mitigate project risks, significantly impacts that selection. And there needs to be a rigorous process. All the contract is a series of terms, conditions, and definitions that are wrapped around it of your core strategy. So if you have a successful core project strategy, your delivery model again becomes an extension of that success rather than the other way around. The analogy I make, and we had a restaurant theme earlier, I'm going to continue on with that. The analogy I make is the project deliverables or contract models are much like a wine list at a good restaurant. I'm not an expert on wine, but I'm fairly certain there's only a few basic kinds of wine: red, white, rosé, sparkling, and probably a few others that I'm missing as well. And that to me is analogous to EPC, EPCM, cost plus, incentives, contract for difference. Now, wines can be broken into a nearly infinite array of variations based on region and winemaker, vintage, etc. And oftentimes, commercial and legal teams and various parties can outsmart themselves in the creation of permutations and variations of core project delivery models that have been in place for hundreds of years. So bringing the analogy to its conclusion, one of the most important aspects of selecting a wine at dinner is what? What will you be pairing it with? So the analogy comes full circle. What is the right contract model? Well, it's what's paired with your project delivery model. Answering a question, and people ask that, I answer their question with a series of questions. What's the status of the project that will be governed? What's the amount of upfront project planning that's been completed at the time of contract formulation? Objective evaluation, detailed planning, de-risking, and time are all essential to the parties to reach the right selection of that project delivery model. The timing of the work, the maturity of the design, the certainty of licensing, the amount of first-of-a-kind activities and evolutions, those are all just a few examples of that upfront objective evaluation of detailed planning that has to be done prior to that selection. One other item that hasn't been mentioned today, I'd like to mention, is another example of diligence. And that is related to the capabilities of owners. A lot of the conversation we've had today is certainly a project team, certainly want to have the best athletes, but the capabilities of the owners are sometimes minimized or overestimated or overlooked during contract formulation. It's interesting to me. AE firms and nuclear construction contractors have a very specific skill set, and owners, by and large, do a very good job of vetting and rigorously qualifying these vendors prior to selections. But in the same breath, owners need to apply those standards to themselves as well. Need to be able to hold up a mirror, be able to accurately, objectively, clear-eyed assess their capabilities. You know, as an aside, in conversations that I've had with AE firms, with technology providers, construction contractors, what I've heard from them is what's needed in these type of projects is a capable customer, or what's referred to in the UK as an intelligent customer. And I think more often than not, that is overlooked when it comes to the project team. An owner is used to the expertise coming in, but you just as much need to evaluate your expertise of yourselves and your capabilities. And that will also guide you to that project delivery model. And so the industry guidance out there today talks about collaborative versus computational contracting strategies. I agree, but a collaboration is only as good as its weakest link. Owners must take their responsibilities and capabilities when coming to, they must take that into account when coming into the table and defining that. So adequately detailing and defining your risks, eliminating optimism bias, and turning it into what I call realism bias, aligning the risk with those who can best manage the project risk. If you can successfully do that and all the variations that come with that, only then will the correct project contracting model and incentive structures present themselves to you clearly. Then you can make a truly informed decision. So lastly, I'd like to talk a little bit about what we've done at Vogel and what has worked for us regarding our contract model and incentives. At Vogel, it's well documented, we started with an EPC fixed price agreement, which had a clear allocation of project schedule and cost risk that was assigned to the contractor. One of the contractor was fully willing to take and did so. They took that risk right up until the point they were no longer able to bear that risk and had to seek corporate protections for the project. So up until that point, on our project, we had, at least from a commercial standpoint, what I can safely say in hindsight now was a confrontational contract strategy. Because it was really that strategy, that fixed price was focused on both sides, trying to protect their business and investment interests to the best of their capabilities. And it caused quite a bit of disagreement between the parties. Transparency was not where it could be on the project. Agility was not where it needed to be on the project. The best athlete at times, because we were locked into a fixed price agreement, had the best roles and responsibilities on the project. So we had a decision point. Since we were a project that was already out of the ground and underway, we had to rapidly assess, number one, could we complete the project, which we proved to ourselves we could. And we received approval from our Public Service Commission under an RAB model, by the way, to continue that work. And we also had to prove to ourselves, are we ready as owners to accept the responsibilities and essentially accept the project risk? Someone mentioned earlier, the project risk was always with owners, whether it was under the EPC agreement. Now it is truly and very clearly with the project schedule and cost risk from a primary standpoint is with owners. And so what we quickly realized, in order to finish this project, we needed a collaborative contracting and project management approach if we're going to finish successfully. And so, as I mentioned, the primary cost and schedule risk has now shifted to us as owners. The primary control of the project has shifted to us as owners. But what we did was establish an integrated organization with owners in the lead, facilitating the teamwork, facilitating that open communications, and being the primary reporting entity for the project. And we developed an integrated plan that interfaces and transitions with our design and procurement contractor, our AE firm, and with our construction contractor. We are very much an integrator and the lead for the project moving forward. So we've created a fair and flexible contracting framework that allows for the status of the construction and the design maturity that we had. It's a hybrid contracting strategy. We've aligned the project risk with those who can best manage the risk. And our technology provider has primary responsibility for design completion. Construction has primary responsibility for construction and subcontract management. So again, it's a collaborative versus contracting approach. Our contractors still have what we like to call skin in the game. There's meaningful schedule milestones. There's meaningful cost targets that incentives are tied to the achievement of those targets. And the contractors within their scope of work have control over that scope of work, but again, are being primarily directed by our team as owners. So in conclusion, these are highly complex and challenging projects. We've learned the lesson that true partnership is required to make these a success. And with clear-eyed, objective analysis of all the participants, adequate time for project planning, and a collaborative project execution strategy in place, the contractor project delivery models become an extension of that successful process. Jan, that's my comments for today and appreciate it.
Yes, thank you very much, Sean. There was a lot in there in your presentation, which in another occasion I would like to go to dig a little bit deeper, and perhaps once we sort of get our project on the way, we'll definitely get back to you and also to Dana and to Milt and to Simon on more detailed questions. Just sort of one thought. In both instances, we heard about this integrated approach, the collaborative approach. Are we talking about sort of structures that are basically vertically integrated for some limited amount of time? These are not the old monopolies of old, which we know from the textbooks, but nevertheless, there's very much sort of an idea of sort of one structure that is really accomplishing that, and then inside you have your hierarchies and your mechanisms and your incentive schemes, rather than normal commercial or standard commercial contracts, which will then apparently lead to some sort of confrontation, probably because some of the topics or some of the issues can only imperfectly be defined, and then lead to ambiguities and to informational asymmetries. And then that confrontational style, which is of course the style of perfect competition and cost efficiency and so forth and so forth, that doesn't work so well. Well, these are clearly topics that will make us think. And in the meantime, we'll be moving on to Jane Gibson. I hope I do pronounce your name right, and it's not Gibson, but you'll correct me if that's necessary. It seems to be Gibson, great. And you're business development director at Jacobs, who is of course a tier 1 contractor in many nuclear projects. And you have a long background in commercial management, not only in the nuclear industry, but also in the defense industry. So you can also compare approaches across different industries. And I would look very much forward to your remarks, but also if you sort of could very briefly comment on this sort of opposition that sort of emerged between sort of the integrative approach and the contractual approach, which I imagine for a contractor is still the right approach. But we'll hear from you. Over to you, Jane.
Yeah, so thanks, Jan. And it's been really interesting listening to the other participants, because I think, yes, I'll give a contractor's perspective, but I will pick up on lots of the same themes. So if I just sort of dive into what I was going to say, I think we'll pick up and you'll hear what we at Jacobs have got to say on some of those same themes. So I'll just share my screen. Okay, so today, as I said, I'm going to provide a perspective from a member of the nuclear supply chain, and specifically what I'm going to do is provide an overview of the main types of contractual arrangements, including how they deal with risk and incentives and how relevant they are today. And I'll give some thoughts regarding the kind of arrangements that we think the market is and should be moving towards. So just really briefly, so Jacobs has a rich nuclear heritage, having been involved in nuclear globally and across all stages of the life cycle, from new build through to decommissioning for 60 years or over 60 years. And at Jacobs, the future of nuclear is really important to us as a company. And so we're committed to working closely with our clients to develop contract models that deliver the many benefits that nuclear brings, including energy security, socio-economic benefits, and of course the environmental benefits. And I'm really pleased to be speaking alongside everyone today at a time that appears to be an inflection point for new large-scale nuclear. And what we're going to say is to capitalise on the current momentum as an industry, we think we need clients, investors, governments and contractors to come together to demonstrate that we can consistently deliver new nuclear builds with cost and schedule certainty. In a worst case scenario, failure to do so could result in gigawatt nuclear becoming obsolete. So I'm going to talk a little bit about some of the contracting models, and I think I'll repeat some things that others have already said. But it is important to say that different countries have different nuclear histories, different supply chains and different funding options available, and therefore contracting structures will ultimately be influenced by the available capability and capacity. So in some countries such as Korea, there is EPC capability where the owner buys the complete solution and transfers nearly all project risk to a prime contractor, But for most countries, it's fair to say there are few contractors with EPC capability. It doesn't always come with the promised cost certainty, as others on the panel have already alluded to. And a high premium is paid by the client due to the perceived transfer of risk, but ultimately the client retains the sometimes all too real risk of contractor failure. And so the reality is that for many, EPC approach is just down to an option. And certainly in the UK, before it was cancelled, the Wilfer project changed its intended delivery strategy from EPC to a client-led multi-contract approach, as it couldn't achieve the required transfer of risk at an affordable price. So in the UK, traditional models are no longer feasible due to gaps in the new build programme following policy change in the 90s, which resulted in Sizewell B being the first and only of a planned fleet of PWRs, which had an obvious impact on the UK's nuclear supply chain. So as a result, here in the UK, as in many other countries, we don't tend to have suppliers with the full multidisciplinary capability, capacity, and or corporate risk appetite to be accountable for all the works and services required for a new build, which in turn necessitates a delivery model which enables a range of supply chain partners to deliver together effectively. Support for more new build came here in the mid-2000s, and for a period we experimented with building new nuclear capacity without government support. But it became evident that the market can't sustain a new build without it. Planned developments at both Wilfer and Moorside sites have failed to proceed for various reasons, but an inability to transfer risk to the supply chain at an affordable price, and the commercial difficulty faced by private organisations in funding the projects over long durations up to final investment decision played a significant role. So a fragmented supply chain and the need for government support and the corresponding government involvement in delivery that brings are two key drivers that UK contracting structures have to accommodate. And the challenge, therefore, is to find a model that allows the owner to effectively bring together multiple delivery partners, ensuring that risk sharing is optimised between the contractor, the owner, investors and government. And this is where the multi-contract delivery models on the slide allow for a more tailored approach to balancing both the control and the risk retained by the owner, investors and government. The multi-contract delivery model can be seen as a continuum where the owner can directly contract with and integrate a greater or smaller number of scopes. Obviously, the more scopes to manage, the greater the integration risk and the greater the management burden on the client. The key package multi-contract delivery model in the middle of the slide, in which the client lets approximately 8 to 10 key packages and often procures support from others in the form of an owner's engineer, architect engineer and a programme management contractor to manage the integration, in our view, is the optimal version of this model. And we are now seeing this approach being considered at Sizewell C based on a refinement taken from learning from the experience at Hinkley Point C, where the client has a far greater number of interfaces to manage. And while the client typically retains more risk on paper than in an EPC model, this risk is managed by packaging scopes to match suppliers' core capabilities, which allocates risk to the party best able to manage the risk. And also, as others have alluded to, with more risk shared between the contractor and the client, they are more likely to come together to address problems earlier at a point when they can be more easily resolved. So one other benefit, and it's a really key one, of the multi-contract delivery model is the ability to identify the key participants in the project with most influence over the success of the project, and to develop a collaborative alliance style arrangement which incentivises and rewards successful outcomes and drives all alliance participants to manage risks collectively instead of allocating blame. This is an approach which is gathering momentum and yielding successes, not just in nuclear, but in other complex mega projects in other sectors. So when an alliance is suitable, so we're seeing a trend in the UK for government working more closely with industry in the delivery of complex and high-risk government-led contracts. And as alliance agreements typically don't provide for further allocation of risk to the supply chain beyond the incentive arrangements, they are particularly appropriate where the nature of the project is such that the client will retain material project risk, or for regulatory reasons, needs to remain involved in the project at a greater level than a traditional approach to risk allocation would support. And with significant investments at this kind of scale, governments and utilities are looking for more than delivery to cost, schedule and quality. And other benefits feature in the value equation in our experience, such as levelling up across regions and other types of social impact. And we have many examples of government clients procuring alliance-based deliveries as they recognise their potential to provide better holistic solutions than more transactional models. The earliest adopters of collaborative models here in the UK were the oil and gas mega projects in the North Sea, closely followed by major utilities projects, including roads, water and rail, many of which we are or have been directly involved in at Jacobs, and certainly collaboration has long been a feature within the UK's existing nuclear and decommissioning markets. And again, at Jacobs, we're involved in many of these long-term alliance arrangements. And personally, I had the privilege of being heavily involved in the tendering and mobilisation of a recent 20-year major project alliance at Sellafield. And alliance contracting is really particularly suitable in multi-party delivery structures for highly complex, high-risk projects, such as those seen in nuclear, as a means of seeking to manage and mitigate interface risk. So just a few points on, I mean, there's lots to say about alliances, but just a few things to pick out. So alliances share a number of key features typically, including the fact that the client will typically have two roles. First as a participant within the alliance, and then also as a project owner on behalf of the investors outside of the alliance. And therefore, effective alliancing requires an investment in team culture that can positively exploit the participation of owner and contractor to jointly mitigate risks and to drive outstanding outcomes. Other common features that we see generally include the formation of an alliance based on express commitments of cooperation and trust, and the alignment of the parties' objectives and commercial interests. The establishment of appropriate governance structures, such as an alliance board and an alliance team drawn from each of the alliance participants on a best athlete basis, and also a commitment to act on a best for project basis under no blame and no dispute provisions. And then finally, aligned with this, appropriately focused and funded financial incentive arrangements that reward outcomes are usually viewed as being necessary to ensure the full corporate commitments of each of the alliance participants. And the overall purpose of an alliance arrangement is to identify those with most influence over the ultimate success of the project and to incentivise them to work together to deliver successful outcomes so that all parties win always together. Incentive arrangements can be complex and will be designed to best suit the project, but typically alliance participants are paid actual costs plus incentive payments which are aligned to overall programme drivers and other critical success factors. Often incentives can be earned based on a combination of individual performance and collective performance, but most of the incentive to be earned is tied to collective outcome-based measures. And from a contractor's point of view, there are a number of questions that we consider when we have the opportunity to link our rewards to outcomes. And they include things like the level of definition of the outcome that is to be achieved, how involved we have been in developing that definition, how much real control we will have over delivery decisions in practice, how aligned the other participants are to the same objectives. Does the incentive recognise the different drivers and seek to align them? And does it drive the right behaviours? Just to highlight a few of the things that we would look at. So alliance-based approaches can be a solution for the delivery of complex high-risk mega projects which require the collective efforts of a number of stakeholders. But we we do think we can and should go further. So if we envisage another continuum with a traditional transactional approach at one end and a fully joined up, high-performing collaborative team at the other, there's room for the alliances that we see in the UK's nuclear industry to move further still along that continuum. Alliancing requires a shift in behavioural approaches and a shift in mindset from client and contractor to genuine partners. And it's not always easy to make this shift. And in our experience, the risk of falling back into more traditional client and contractor roles is often present to some degree. So we think closer alignment is key to avoiding this risk. At Jacobs, we want to work closely with our clients early on in the journey while solutions are initially being developed. As contractors, we're often disconnected from other key project stakeholders, such as regulators, government agencies and investors. And so an opportunity is lost there to respond with agility to their needs. We are committed to the long-term future of the nuclear industry. And whilst our shareholders have certain expectations, we are not driven solely by our ability to make money on individual projects, but rather by exploring innovative solutions to ensure sustainable returns for the long haul. And in the case of nuclear, this means finding models that deliver cost and schedule certainty to maximise the likelihood of future builds. So we want owners and investors alike to consider the value that could be realised by bringing prime contractors to the table at an even earlier stage and really exploring our respective drivers and building together a delivery model which reflects the full benefit of our jointly pooled expertise and resources. We think there's an opportunity to unlock better project outcomes by aligning early, genuinely collaborating on all decisions, including how and when to invest resources, operating with full openness and transparency, and through commitment to a single cost and schedule baseline for all, providing for true alignment of objectives, drivers, and rewards across stakeholders. So, to briefly summarise, as an industry, we need to continue the direction of travel towards pulling together and embracing alliance models and effective risk allocation and sharing. A truly collaborative approach will recognise the unique strengths, capabilities and resources of the owner, investors, government and the delivery partners, with genuine shared control over delivery outcomes, ownership of risks and entitlement to rewards. Thank you.
Great. Thank you very much, Jane. Well, we'll certainly come back to the alliance approach in the questions. I already see a question to that, but I'm quite, how should I say, it's quite noticeable that the three experiences we heard from industry pretty much go in the same direction of that integrated alliance building collaborative approach that basically no longer sees a divergence of interest, but very much will sink together, will swim together, and we'll just need to make it work. We'll come back to that in the discussion. Our next speaker will be John Parsons. He is the Executive Director at the Center for Energy and Environmental Policy Research, the CEEPR, well known for those of us who work in that field at MIT, Massachusetts Institute of Technology, and of course he's professor at the Sloan School of Management, professor of finance, and his many publications in the field of finance and energy are all well known to, or at least to us who would work in similar fields. In particular, his latest, The Future of Nuclear Energy from 2019, that set out many of the issues that we're discussing today. And so also our webinar today, to some extent, builds on that earlier work. John, can you sort of start drawing together of what we have heard until now, and whether this sort of enthusiasm for collaboration, partnership, and integration in the industry is sort of covered by what your view from a more sort of academic perspective would also validate? Over to you, John.
Great, thank you very much, Jan, and it's a pleasure to be here. It's been very fascinating to listen to these contributions. It's a great bit of work that the NEA has been working on this area for quite a while and making very good contributions. I'm going to talk without any slides, and I will try to do as Jan requested, to pull a couple of things together. I'm going to say first, putting aside contractual assignments of risks and contractual structures, I think many of the speakers here have made very good points that the contractual structure is really only one piece of the puzzle. All of the preparation, I would also say all of the capacity to manage projects, or if not being the manager, to engage on projects as a participant of an alliance, as an owner, working with the contract manager, or what have you. That capacity building is obviously really key. And you have to apply that capacity building to a project that actually promises to have low enough costs. In the end, having a good contract structure is not going to make up for the lack of capacity. It's not going to make up for an expensive project. It's not going to fix your problems, but it can be a partner in avoiding problems if the rest of your arrangements are deep and sound. Having said that, let me focus on project structure and risk assignments. And I'm going to talk about three different types of risk that I think it's really useful to distinguish. The first type of risk I'm going to call market risk. And I think of that as the day-to-day fluctuations of the price in the electricity market. For example, here in the United States, in many of our markets, natural gas plants are on the margin many of the times. And as natural gas prices fluctuate up and down, electricity prices also fluctuate up and down. Other factors come to bear as well. We have parts of the United States that don't have very significant load growth, so their prices are lower than other places. Those market price risks are one category of the risk that you could shift in a contract. When Hinkley C was being negotiated and the contracts for different structure was being evangelized, the focus was put on market price risk. And the advertisement was, if we shift the market price risk to the government, that will lower the cost of this power, of this new nuclear power plant. And that's the best way to make it deliver. A second kind of risk, which has been the focus here a lot, is construction cost risk. And as we started off with Simon, the RAB model is a way of removing some of the construction cost risk from the vendor and is being advertised as a way to lower the cost of the overall project. I want to also bring up a third risk that we haven't mentioned here. I'm going to call it public commitment. Private investors and public authorities are going to invest, let's say, $12 billion in a new power plant. Once they finish building it, it's going to take years to produce the profit to recoup that investment. Will the rules of the game change after you finish completing building the plant? We have many examples where they have. We have countries that have decided to exit nuclear entirely and retire plants early. We have examples of other countries that have levied taxes, specialty taxes targeting only nuclear power plants, for example, on the nuclear fuel. We also have other situations where the rules of the marketplace have been jiggered and the expected return on the project has been lowered because, for example, here in the United States, we subsidize competing technologies outside of the market, but we don't provide the same subsidies to nuclear when we're looking for low carbon energy, for example. Those subsidies that are channeled outside of the market drive the wholesale price down and are one reason we have some existing nuclear plants that have been closed prematurely because it's no longer profitable, even though those plants are clearly very economical, clearly very valuable assets, but the regulatory structure has been changed to undermine the financial viability. So those three types of risks are very different types of risks, and which one is most important? Maybe they're all important, but what are we trying to target? I mentioned a minute ago that the Hinkley C contract was advertised as shifting market risk to the state. But I think the contract for difference structure of the Hinkley C contract was a complete diversion from what was actually going on. It was kind of like the magician who wants you looking over here when the real act is going on over there. If you look at the contract of Hinkley Point C, you will find there are many details, the fine print, if you will, that speak to the third risk I described, the public commitment. So, for example, there are footnotes in the fine print language in the contract that lay out if the government levies new taxes, then the price is going to be adjusted to guarantee that the investors will get the same return that they had originally anticipated. That's an example of a contract structure dealing with this public commitment risk. So, in my opinion, the market risk is not an issue. Here in the United States, back in the 2000s, we had many parts of our country had liberalized wholesale electricity markets with volatile prices. We had 6 gigawatts of nuclear capacity added in those markets because they anticipated profitability from those investments. And we have academic research that demonstrates that investments were more likely to be made in liberalized wholesale markets than they were to be made in the regulated asset-based markets that we have in the United States. So I just think it's not true to think of market risk as the problem. I think the real issue is public commitment. Now, construction risk is a harder issue. Clearly, there's some benefit to shifting construction risk to the vendor. We've had some discussion here that I agree with, that imagining that you've somehow disappeared the risk because you've written up on a piece of paper that it belongs to the vendor is not wise. There is always some risk. If the vendor fails, what are you going to do? On the other hand, I think several of the companies that did assign the risk to the vendor are much happier than that they did once they discovered all the problems. They're a few $1 billion happier than if they had assumed that risk without paying attention to the vendor being unable to do it. There are always vendors who are willing to offer services that they can't actually perform on. It's good to have a contract structure that weeds out some of those and also that protects you from some of the risks. But I think it's a good point that people have made that perhaps there's too much risk on vendors for projects of this size. Perhaps there are public authorities who have to have some skin in the game. So I think the construction risk is a much more complicated issue. One of the attendees to this workshop has already put in a question asking about advanced reactors. In our Future of Nuclear study, we pointed out that the public has a benefit from the development of these new reactors. The public wants to provide some kinds of, some of the capital, should provide some of the capital for these. On the other hand, we really want the developers of these new reactors to have skin in the game about what they're proposing to spend public dollars on. And so we recommended ways for the risk of the new development to be held by the developers, while at the same time the public could be promising significant returns should they be able to carry out their commitment. But it's a very complex issue. So I think if we move forward with things like RAB, I think we need to try to be more clear-eyed. I think it would be good for some of my, the question got raised, oh, it's good to use RAB because politically people can't see how much of the risk is being moved. That may be true, But it would be nice if among academics, we would try to identify how much of that risk, how costly is the moving of that risk, and where is the benefit. But I think it's a very complex issue, a difficult one, and it really requires sensitive and experienced people to bring good judgment to the question and find the right balance. With that, I'll look forward to the discussion and the question and answer session.
Thank you very much, John. I agree with you on the point that we sometimes confuse market risk and political risk, which is to some extent shifting the baseline of the market, and then it's blamed on the market, but in reality, the political framework has changed. But on the RAB, and we'll certainly have a discussion at one point in the future with you and Simon and Michelle and others. I mean, as an economist, I'm still wedded to this idea of the famous Arrow-Lin theorem. Basically, if you can spread the risk around smoothly enough, then nobody really feels it, and overall society gains. But I also don't understand the limits to that. But definitely, there's a discussion to be had, and I look forward to that. With that, we come to the final speaker of the panel. It's my colleague Michel Barthélemy from the Nuclear Energy Agency, who is energy analyst, nuclear energy analyst, and leads a number of important projects on economics of nuclear. And the Red Cost study, he was one of the two co-authors that was very successful. Works also on new nuclear, I mean, new technical SMRs, Gen 4, and the fuel cycle. And before joining the NEA, Michel was responsible for economic studies at the French CEA, the Commissariat for Atomic Energy. Michel, you'll briefly give a pointer on our work, and then the remaining time we'll have the questions, of which we already have a number of very interesting ones. Michel, over to you, please.
Thank you, Jan. Good afternoon to all. It's a pleasure to join such a distinguished panel. Have the great challenge of coming after a lot of very insightful presentations. And what I'm trying to do in a short presentation is to bring together some of the arguments we've heard for the last hour and a half, and link that to some of our recent and ongoing work and at NEA in such a way that help to link this issue from a conceptual level to really a more practical approach and hopefully some policy relevant implications. I'll start with a simple chart that we have in one of our recent reports that Jan talked about, Red Cost. It's essentially highlights what we all know, that nuclear power economics is dominated by the cost of capital. Nuclear power plants are some of the most capital intensive projects we have to build. And we can clearly see here the relationship between the cost of capital and the levelized cost of electricity. So then when we think about these issues and we discuss them, we tend to think, okay, so there's an issue with the cost of capital. What should we do? Well, we need to address the financing. And you can see here some example of financing approach. You can have a purely merchant approach, which has never really happened for nuclear on the right-hand side. Then if you go further down, you may be around where Hinkley Point C got signed off with its contract for difference and all the footnotes that was referred to earlier. And then, the discussion today is how do we move further to the left towards regulated models such as RAB. And indeed, in such approaches, you have to deal not only with market risk, but also find ways to tackle construction risks. All of that is true, but during all of that, I've only talked about financing. And the key point I want to make is that financial framework should not be looked at on its own, independently of a range of other key strategic decisions for a nuclear project, in particular the ownership model and the procurement arrangement. And to some extent, we often hear there is an issue with financing. Well, maybe there is not necessarily an issue with financing, but there were an issue with these other parts and that were not tackled, and in particular that might not have been tackled early on when you were defining your key objectives for your project. So having said that, what can we say about key principles for efficient risk allocation? And I hope you will see on this slide some topics that have already been touched upon by the previous speakers. First, this is a point I just made, which is that in the end, the cost of capital will reflect risk allocation decisions. And that will be done so not only through the framework, but also through a range of other contractual arrangements. And in particular, how do you set up your procurement strategy and what sort of ownership model you want. And there are trade-offs and links between all of them that really need to be understood from the start. Next, how do you allocate risk? What sort of key principles should you follow? And often it starts with a lot of common sense and this mantra that you need to allocate the risk to the parties that is best able to manage it. And there's a lot of truth and a lot of merit in this. But it's only, yet again, part of the story. This is only ex ante. The question is, what do you expose if you hit some problems? Well, there you need to make sure that the way you've allocated the risk means that the parties are able to absorb this risk. And to some extent, we've heard that from Sean about Vogel. They were very happy with the project approach up to the point where some of the key contractor went bankrupt. So there is clearly one key trade-off. Another key point is we know that this project, regardless, will be incredibly complex. And that means from an economic perspective, they come with very high transaction costs, and that contracts will always be incomplete. As much as you bring in your best lawyers, you're always going to hit some challenges. And that means what you should be concerned about is not only did I give the risk to the best party who can manage it ex ante or export, but also are we aligning incentives here, or are we just setting the stage for lawyers to set up claims when we hit problems? And I think if we look at recent first of kind project, there's a handful of evidence that sometimes this has been the case. And the last point I want to bring in here, and maybe this one is a bit more speculative, and we can go back to into the Q&A, is that in practice, does the party has to bear all the risks to be incentivized? Potentially not. Potentially not, because what we also heard earlier is that there is a lot that goes into a project in terms of leadership, in terms of the leadership of the project management team, and this consideration, are not all going to be ruled by what is written in contract. And so if you take those into consideration, you can also find a better compromise. Now, having put these issues at a conceptual level, I wanted to link that to also how do we go about it in practice. And here's something we've paid close attention at NEA over the last few years is on making sure we learn lessons from recent first-of-a-kind projects. In particular, for today's webinar, they do offer a lot of valuable lessons when it comes to how do we approach contractual arrangements. In particular, one of the things we've heard already, again, is how some of the fixed cost contractual arrangements didn't lead to alignment of incentives. And what we can see there is that a couple of things happen when you do that. First, early on, in fact, you have what we sometimes refer to a margin on margin effect, meaning that contractor gonna have to take some risk margin for accepting to take more of the risk. If the contractor is trying to shift more of the risks further down the supply chain, the subcontractor is gonna have to take risk margins, and you're gonna multiply margin on margin. And at the end of the day, first of all, the risk has not disappeared, as we know and heard. And second of all, you end up with the cost of the project, which reflects the misalignment of risks rather than the true cost of the project itself. And secondly, point I've already made is that if the risk does materialize, well, you opt for some serious litigations, and that, in fact, in itself can make matter worse. Having said that, what should we do? I was very happy to hear several of the other speakers touch on some of these considerations, in particular on the importance of engaging the supply chain early, aligning incentives, I've already said, and in particular in sharing risk and rewards. And here, we know in particular that alliance models or extended enterprise model, for instance, that has been used successfully in the airspace industry, can help to address these issues. And so key question is how, if, and how, and it's more how, because we have some data that it's possible, how can we apply those to nuclear projects, and in particular nuclear new build projects. Now, I will finish with a pointer on one more issue, because so far we've talked about managing things through contracts. The other side of that coin is managing that through changes in the way your supply chain is organized, and in particular, when and how should you choose to vertically integrate yourself with your supply chain. And here, I think it's useful to go one step back to a more conceptual level, and from the economic work on transaction cost, we can indeed identify some key conditions that will lead us to prefer or to choose to vertically integrate your project or your industry, and substitute from contractual relationships. In particular, there's a key trade-off here between the level of specificity of an asset and the frequency of transactions. And if you have an asset which is highly specific and frequently and with high level of frequent transaction, this is typically where you will want to vertical integrate your project or your industry. Having said that, in between, there's a lot of different models, different approaches. We don't have time to explore all of those in details today, but I'll just point out the fact, and this is very important for the nuclear sector, that if we think at a very high level about large nuclear power plants versus SMR and or advanced modular reactors, you can see from the outset that probably this consideration means that the supply chain is going to be set up differently. And as part of our work at NEA, we start to see that clearly there is need to start considering, what would be the right industrial structure for SMR, which in turn has indeed important implication for contractual approaches in this field. With that, I'll stop now and look forward to the time we have for the Q&A.
Great. Thank you very much, Michel. That was a good overview of the work that we are doing, that we hope to do, and look forward to working with you in the coming months on these issues. We move now to the question and answer session, and it will be short because we will finish at around 4 o'clock Paris time, as we said, in about 15 minutes. Many questions were actually already answered directly by you, in particular by Simon. Thank you very much for that. That is very good, and I'm sure the people who asked the questions got the answers they were looking forward to. However, there are 2 questions that are being addressed to Sean, and I'll read them out together, and because they can be answered together, and we'll start with those. And Sean, the first one is from Matt Crozat, and he says, you make an interesting observation that the resident capabilities of the owner are often ignored. That was a human capital building that was mentioned several times. But then the question is, had that been considered from the outset of the project, do you think the initial approach to risk allocation and contracting would have been different? And immediately the second one, coming from Anne McLaughlin, if you had started out with that collaborative risk sharing model that you now have implemented, would you have been able to get the Vogel project through the board and through regulators at the time? So two very interesting questions. Please go ahead, Sean, and anybody else might want to chime in afterwards.
Sure. So I'll address the first one first. And you know, would we consider the approach differently if we had the capabilities at the time? And I think the answer to that is yes, but you have to, hindsight being 2020, you know, when you're looking at approximately 12, 13 years ago, when we were really considering, you know, what type of commercial relationship we had in the US, we had roughly at that point, you know, a 20 or 30 year gap in nuclear new construction that was ongoing. So the resources and the skill sets were not refined really on multiple parties in the US because of that gap in time frame. Now, if we were going today, I think we've developed those skill sets. Our contractors have developed and refined their skill sets. And I think for other new projects worldwide, they will be able to capitalize on the momentum that you've seen from the projects that we've had here and others that aren't represented today. So you're seeing a building of a momentum there, a building of human capacity that I think is very much applicable there. To the second question, I think really the essence of that question is, does your contract delivery model affect how the board and the regulators make their decision? And I would say, to a small extent, what the board and regulators, what our regulators are looking for cost certainty, they're looking for schedule certainty, they're looking for us to deliver best value to our ratepayers and to our customers. The contracting strategy and methodology is one aspect of that, but it's by no means the key factor. It's what level of confidence can you project to achieve cost and schedule milestones.
Okay, thank you very much. Very clear answers to interesting questions and interesting answers. Anybody else who would like to come in on this? If that's not the case, I would like to repose a question to Jane that she has already answered in the direct chat. But I think it's a question that is of such interest to all of us who are struggling to what is exactly happening with this alliance approach. And Jane, you can basically just read out what you wrote in your answer. But I'll just read out the question by Mike Lewis. Jane, can you provide any comment on the contractor paradox of alliancing at project level and corporate board drive for market share and profits? Is there a necessary culture change here? And I think it goes to the heart of many of the issues we've discussed today. So perhaps you could just say the answer that you already wrote.
Yeah, I mean, I will do, and I think it's a good question. So what I've sort of said in my answer is that, you know, we do care as contractors, we care about the long-term future, not just snapshots in time in terms of market share. So because of the particularly fragmented nature of the UK supply chain, we do think the multi-party model is the only viable delivery model in the UK at this time, and therefore the only one that's got the potential to support a long-term programme. And if there is no long-term programme, there's no market share for anyone. And conversely, if we can secure the long-term future, then there's enough market share to go around. And then I think on the question of culture change and partnering and alliancing with our competitors, you know, we were reflecting on, say, 10 years ago when the concept of alliancing and forming joint ventures and partnerships with competitors was new and soft and unheard of. And then when it started to come out, it was, some people reacted in horror. It's a little bit scary, but actually it's now the default position for many projects. It's almost business as usual partnering with competitors. And as I said, we might therefore argue that the culture change is already well underway and we're just on that journey.
Okay, thank you very much. That's a real challenge also for us as economists. We understand the market, we understand the hierarchy, the enterprise, but with this sort of, well, to use a fashionable word, hybrid alliance approach, we sometimes struggle, but we're also learning. So this is a very very good thing. Thank you very much. There was also one question more to sort of the interplay between the project developer and the government, or the role of government. Diane, would you like to pose it, or you prefer that I deal with it? Go ahead.
Hi, I'm happy to pose that, and thank you for the opportunity. First of all, thank you to everybody for these really interesting panel remarks. And the scope of people's remarks has really spread across a number of interrelated issues, not strictly speaking just contractual arrangements and how we design efficient incentives in contracting, but you've touched on very closely related topics of management, business structure, strategic partnerships, and financing. And my question maybe interweaves a little bit. Mainly it's aimed at Milt, but I would welcome the views of others on the panel as well. My question is this. There are two very large projects. They're not nuclear new build projects, but they're refurbishment projects in Canada right now. One is being advanced by OPG at Darlington. We heard from OPG, from Zena today. There's another project of a similar magnitude being advanced by Bruce Power. And some of what these projects have in common is sort of they have similar can-do fleets, similar aging fleets, similar supply chains, timelines, and the magnitude of the investments is similar. But there are some differences that go to business arrangements, that go to the governance models and the respective roles of government and private sector in the operations of the two plants. One is under OPG, which is in Canada called a Crown Corporation, which has a particular flavor of a government institution in Canada. The other is a public-private partnership with a different role for the private sector. And so I wonder if this creates an opportunity to sort of glean any lessons learned. Are there any interesting lessons learned from the differences between how these two models are progressing that could help us understand efficient contracting?
Well, thanks, Deanne. And that's a good question. And I was heavily involved in both. And I think I wrote one answer in the chat. I'll try and answer it a little bit differently here. I think part of the issue is there are many areas where there's differences. There are many areas where things are the same. And part of the understanding has to go to, we have this sort of pre-established sense of this model means this and this model means that, right? And they must be different, but the devil's in the details. So for example, OPG is a provincially regulated utility. Its shares are owned by the government, and it has a standard North American regulatory model where it has to get its costs approved by the rate regulator, and costs that are deemed not prudent have to be swallowed by the shareholder, who in this case is the government. The Bruce Power agreement, because Bruce Power is a private sector operator, Their agreement is with their counterparty, who's the system operator, the Independent Electricity System Operator of Ontario. And theirs is a contract for difference model, actually. It's very similar in structure to the Hinkley C, but with a number of differences. One is they have the benefit of that model is for an 8-unit operating fleet. So it makes it much more easy to manage what the cost of energy should be. They always have revenues coming in. It's not like a new build where you have, no revenues coming in until the plant's complete. But when that contract evolved, the nature of that contract for difference in terms of the risk sharing is very, very different than Hinkley Point C. So they still have a structure where they have the ability to work out and set the price of each refurbishment as they come up, and then those go into the rate that's paid by the customer, rather than how it started. The original contract at Bruce in 2005 was sort of a standard power purchase agreement type contract. We're going to refurbish 4 units at Bruce A. We think the cost of building them is X. So we're going to start charging for the price of power, this price of power subject to escalation, and that's the model. What we learned when we renegotiated the contract is that just because you have a power purchase agreement, it doesn't mean the model has to be that the price of power is 8 or it's 8 plus escalation. You can still pass through whatever risks you want. In theory, a power purchase agreement just means you have somebody that wants to sell power and somebody that wants to buy it. You could agree on any basis for the price. And so there was a lot of evolution in the Bruce agreement that said, well, yeah, because again, it's different from a traditional new build because they're doing 6 refurbishments with the last one starting in 2030. And, in 2015, they said, well, we know what needs to be done. And I can tell you this pump needs to be replaced, but you would have to pay me much too much today to say, guarantee the price of what a pump I'm going to buy in 2031 is going to be. And so we manage that so that they do have an ability to, do the work, the same as OPG, get prepared, develop the project, and then only when the project meets a certain criteria is the cost of that project reviewed and the cost put into the rate base. Now, it's not a rate base, but the rate and now the difference is once they fix that cost, they take the risk of overruns. OPG, it's difference. Once they fix that cost, they still have to convince, if overruns happen and they're allowed by the regulator, they may be allowed. But I think the most important thing is that the 2 utilities have a collaboration agreement and they're helping each other be successful and they're learning from each other in terms of the models that they're doing. Because, Zena talked about lessons learned, and we have to remember lessons learned, there are 2 words there, right? There are a lot of lessons coming from projects, but that doesn't mean that somebody actually learned them. Learned is an active verb. And you need to be able to demonstrate that the person who has to implement the next thing actually learned that lesson and can put it into practice. Anyway, I'll stop there because I'm using up the rest of the time.
Thank you very much, Milt. That was a very, how should I say, a good case study to conclude our afternoon that brought up a lot of very thought-provoking comments, and we'll try to learn. You said that very nicely. We'll try to learn the lessons that were transmitted this afternoon to us through that panel. And I would very much like to thank all the 7 panelists who had from different perspectives, but nevertheless there was some convergence, and we need to sort of put that into words and sort of really work that out. What I tend to do is to ask everybody at the very end of an afternoon to open their microphones and to give a little applause to your fellow speakers, and that is always very nice. So if you could quickly do that, that would then be my final word. Many thanks to you. Thanks a lot. Great. With that, thank you very much. And Jan, perhaps you wanted to say some final word also. Otherwise, thank you and goodbye.
No, I'll just echo your thanks, and it's certainly a lot to think about, a lot of interesting perspectives, which we will absolutely be taking into account as we move forward in our own program of work at the NEA, and always happy to partner with IFNEC on this great series. So see you at the next one.